If you have been looking at your stock portfolio over the past few days, you may have seen your stocks going up by quite a bit. Well, unless you have been buying lousy stocks, then that's a different story altogether, yeah? The reason this has happened was because of what the Fed said last week, where they suddenly indicated that they will be cutting rates in 2024. All of a sudden, the markets be like, "Chunga!" and started going up hugely. The Dow Jones Index broke all-time high, while the S&P 500 and the Nasdaq indexes seem like they are about to break all-time highs soon. So, in this video, I'll be talking about everything you need to know. Why is this such a good news for the market? Will the bull run continue, or is this just a fake rally? And more importantly, what should you do now? But before I start, do join my Telegram chat group to discuss personal finance or ask any questions that you may have. And with that being said, let's jump right in. To understand why the market reacted so happily, we have to first look at what the Fed said prior to this. So, every quarter, the Fed has something called the dot plot, where they will agak-agak tell us where they think interest rates would be in the future. In September's dot plot, most of the Fed members agreed that the rates should be around 5% by 2024, with one guy even suggesting that rates should continue going up to 6%. He be like,
"You will not know your way of cake."
This was reiterated earlier this month, where the Fed again said that it was still premature to talk about rate cuts, and more rate hikes could still happen. And surprise, surprise, in the latest FOMC meeting, the Fed now say that there will be 3 rate cuts next year, and this time they agreed that the rates should go down to around 4.5 to 4.75% range. Though, as usual, there were some guys who think that the rates should be kept high at current levels. So, why did the Fed suddenly make a big U-turn? Short answer, inflation. You see, the whole reason the Fed wanted to raise rates in the first place was because back then, the inflation rate was rising quickly due to the COVID lockdown and the Russian-Ukraine war. Fun times. But at the time, the Fed still thought that inflation was just transitory, a temporary inflation that would go down by itself. This continued on well into March 2022, when the Fed finally started raising rates. But by then, the inflation rate had already soared all the way to 7.9%, the highest it has been in 40 years. As a result, the Fed had to play catch up and raise rates quickly in order to bring inflation back under control. Thankfully, this worked. And as of last month, the Consumer Price Index showed that the inflation rate has finally come back down to 3.1%. So, when you take the inflation rate coming back down and the Fed indicating that they will cut rates soon, you get the market going to the moon. So, problem solved and the market will continue going up from here? Well, yes, but no.
What?
Quick pause. Did you know that besides Weibo's awesome deals, Weibo also has a global community with its 40 million downloads? At the feeds page, you'll be able to share your investing experience, insights, and tips about the stock market, while at the same time, learn from one another in order to further improve your investment skills. Besides the usual discussion, there are many different groups where you can join to discuss different topics. For example, there's the options group where you can discuss everything about options. Or if you see an account that you like, you can also follow it to get updates from it. Some of the accounts that you can follow are Macro Market Radar, Stock Essentials, Options Education, Weibo News SG, and Weibo Learning SG. Weibo is currently running a welcome promotion where if you sign up using my link down below, fund any amount and keep the money there for 30 days, you will win 10 free shares each worth $3 to $500. Besides that, there's also a Money Boo promotion where you can get up to $3,000 cash vouchers by funding $100,000 or more and fulfilling the requirements. So if you are interested in trying out Weibo, do sign up to them using my link down below. With that being said, let's get back to the video. You see, the economy and the market is never dependent on just one thing, where it's like,
"Oh, the yield curve has inverted. We are going to see a recession soon."
or,
"Ooh, rate cuts. The market is going to the moon."
it's not so simple, yeah. So let's look at some of the bull and bear theories as to why the market could go up or boom and crash back down. Starting with the bull theories first. Right now, there's a lot of money sitting on the sidelines, and by a lot, I mean a lot. Currently, there's about $6 trillion sitting in money market funds. To put it in perspective, Over the last 12 months, there was a total of net inflow of $1.3 trillion in money market funds, which is way higher than the total net inflow into equities and bonds. And it was reported that fund managers were still holding a substantial amount of cash. This means if the market was to start going up from here, more and more investors will FOMO and be like,
Fire!
and more money will start flowing into equities, which will lead to the markets going up even more. Remember how the Fed said that there will be 3 rate cuts in 2024 and they will bring the rates down to 4.5%? The market be like,
I don't believe you.
and instead it's now pricing in 5 to 6 rate cuts and believes that the rate would instead go all the way down to the 4% range. Will this come true? Maybe. Many of the factors that have caused inflation in the first place are now almost gone. Energy prices are now low, the inflation rate has been coming down, even shelter inflation, which is a lagging indicator, is now starting to come down. Meanwhile, the labour market remains strong, unemployment rate is still low, and GDP growth rate even went up with no recession in sight. All this shows that we might be able to see a soft landing after all, which means the market could continue going up. But then, you may say,
Doesn't the market always crash when the Fed pivots?
well, yes, but no. One thing you have to understand here is that there are 2 reasons as to why the Fed pivots. 1, they pivot when they have achieved their goal of bringing inflation down. And 2, they pivot when they want to save the economy. In 2007, the Fed cut interest rates to save the economy from the financial crisis. 2000, saved from the dot-com crash. Same for all the times when the Fed cut rates during these periods. But when the Fed cut rates in 2019, when the economy was still doing well, the market shot up. Same for the 1990s rate cut, where the market gave the longest bull run in history. And in the 1980s, when Paul Volcker finally cut interest rates after inflation came down, the market also went up over 100% in 5 years. So this is very similar to the current situation we are in right now, where everything is still doing well and the Fed wants to start lowering rates. That's why many people believe that the market will continue going up from here. But now, let's also talk about the bear theories. Right now, the US personal savings rate is at 3.8%, which is very near to its lowest point in history. According to an article, this is because they are now spending on once-in-a-lifetime experiences because they worry they may not be able to do them later. Stuff like concerts, trips, and designer handbags. At the same time, US household debt has risen to $17 trillion, with credit card debts going up and delinquency rates on credit card loans have also gone up too. So, guess what happens when you have low savings and high debts? Yes, some people will default, others will cut down on their spending, and as a result, this could lead to the economy slowing down, which could eventually lead to a recession. Besides that, while the job market still remains strong right now, US firms are now slowing down their hiring, while the US has also added less jobs in the recent few months. Meanwhile, the Purchasing Manager Index has also been falling recently, which may suggest that the economic activity in the sector was falling.
But why is this happening when everything is alright?
That's because while interest rates have gone up, the effects of it are not immediate, as it may take at least 12 months for a rise in interest rates to have a widespread impact on the economy. So, we are starting to see the impact of this now. In fact, if you look at history, whenever it's finally time to do a rate cut, people start losing jobs. On average, the unemployment rate goes up to 7.5%, which is about twice as high as what we have right now. And according to a financial data platform, non-financial S&P 500 companies have about $108 billion in debt due in 2024. This debt carries an average interest rate of 2.8%. So even though rates will be coming down next year, these companies will still be refinancing at a higher rate, which means higher expenses for them. So what's next? One thing's for sure, we will likely see a rate cut in 2024, assuming inflation doesn't go back up, of course. But as to whether it's 3 rate cuts or 6, we will just have to wait and see. And while the market has priced in a rate cut by March 2024, personally, I think that it may be still too early to do a rate cut. That's because while the inflation rate has come down substantially, it is still not at the 2% target that the Fed has set. The last thing the Fed wants is when they start cutting rates, everyone be like,
I'm Mustafa!
and spend money all over again, which will cause inflation to go back up. Then it will be like, shit,
here we go again,
kind of situation. But at the same time, the Fed wants to be careful not to leave rates too high for too long, because that will cause a hard landing. That's why they want to cut rates as soon as they think the situation has improved. As to where the market will go from here, obviously no one knows for sure, unless you are hardcore. But it's always fun to make a guess. You have analysts who range from being bearish all the way to bullish. JP Morgan believes that the market will drop by 10% to 4,200 points, while Goldman Sachs believes that the S&P 500 will stay at current levels. Then, you have extremely bullish analysts who feel that the market will go all the way up to 5,500 points, or a whopping 17% from current levels. Though, the average price target is around 4,838 points, which is again near current levels. But if you ask me, personally, I'm a little bullish now, where I think that the S&P 500 could continue going up from here, but we won't see a crazy 25% kind of return that we have seen this year. So probably around 10% from here. So what should you do now? I feel that despite the recent bull rally, there is no need to FOMO in. You want to FOMO in, you should have done that earlier this year lah. But also, do take some time to look at where you are parking your money now. That's because with the lowering of interest rates soon, you can expect bank savings interest rates, bond yields, and money market fund yields to start going down. In fact, the Singapore 10-year bond yield has already been trending down. So if you have money that you need in the next 1 to 5 years, now is the time to start locking in those high yields by investing into stuff like Singapore savings bonds and fixed deposits. This includes investing your CPF OA money into T-bills if you have not done so. Other than that, make sure you have a 3 to 6 months emergency fund saved up, and for the rest of your money that you do not need in the short term, just invest consistently. Market up, you buy. Market down, you cry a bit, then you buy more. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.